Hi everyone, and welcome to this week's version of Prop Desk Weekly. I want to necessarily call it this week's version because it's always the same. We'll provide you with an update on the market, see where activity is, and if there's any interesting trading opportunities. My name is Alejandro Zambrano. And as well, before we start, I will share my view on the markets, but this is made with educational purpose. It does not make investment advice. As well, bear in mind, obviously, if you are trading with a real account, that we may lose all of our invested money. And if you're trading with leverage with some brokers, you might even lose more than invested. So, what's going on? Well, the US backs down. I think you already know this. Trump was under pressure from billionaires like Bill Ackman, which proposed a 90-day pause on tariffs, something that actually happened at the end. He's now also proposing that there will be 90% pause on tariffs on China. But we have seen the situation between the US and China escalate. The latest numbers from today is that China is facing tariffs of up to 245%. Now, the reason for this, of course, is that it's extremely destructive for the economy. It is very difficult for companies and small businesses and even big companies like, say, Apple to adjust because the manufacturing sector and the know-how is extremely strong in China after many different companies relocating there. So if you need something, you can usually contact vendors there and they will find a solution for you. Today in the US and many parts of Europe, it's either too expensive to do what you need or they just don't know. So it just takes forever and you usually need to buy in very large sizes. And that's why Bill Ackman here, which was a Trump supporter, by the way, suggested in that polite note on Twitter that we should have a pause. Then we had as well JP Morgan boss Jamie Dimon. He said that the US is at a 50-50 chance of a recession. That as well influenced the move to pause tariffs. And we also know Elon Musk, he published videos on Twitter uh, by Milton Friedman, which was an economist, very famous economist, and was sort of spearheading the free trade that the U.S. Developed because the U.S. did push through with, um, you know, free trade since the 1950s or so. Now, what actually happened then? Well, this is now already a bit outdated, but we went from the most extreme levels to now everybody at 10%, with the exception of China, which is at 245. As well, the Chinese themselves have placed a tariff of 145%. I think it's 125% on the US. Now, what's interesting is this. Do you remember India? So we said that India, to make the trade fair between India and the US, tariffs needed to be at 12%. And we said that 12% is probably going to be the highest one. So if they actually introduced, tariffs where there's limitations on US exporting to other countries, if that was sort of balanced, then India with its 12% would have been at its highest level. And you would have countries like European Union at maybe 2 or 3% tariffs. And we have other countries like Japan as well, pretty much being at zero. But obviously, now the high end, which was India's 12%, is closer to everybody's lower end. And this is where we are right now. If there is no change in the policy of the US, we will head towards lower economic growth and also higher inflation, which would limit how many rate cuts we could have. Um, this is not going to happen immediately. We have seen some reports from a company called Trueflation, and where they measure inflation, and they estimate that inflation right now is at maybe 1.5%. So why would it be at 1.5%? Well, because firstly, we have a lot of people buying things before the tariffs kicked in. That's number one. So there's less consumption probably right now. Number two, people are genuinely worried about their jobs, which means they consume less. So when people consume less, then there's less demand. With less demand, you usually, and the supply remains unchanged, you usually have lower prices. So that's what we're dealing with right now. But make no mistake, the less consumption usually leads to lower economic growth, and not just here, but across the world. Now, we did have some sort of exemptions, last minute exemptions, but again, there's a lot of flip flopping here, which investors don't like. So, Trump exempted smartphone and computers from the new tariffs because they realized that it will be very difficult to create this in the US, something we warned here um, before the election and after the election. And, that was exempt. But then on Sunday, he said it's not exempt, you still have to pay 20%. So there's still a lot of pressure on this sector. Chinese, they retaliate. They don't want to export rare earth metals to the US. So now there's going to be some sort of licensing and where you need to sort of prove that whatever you're getting the materials for is not going to end up in the US. This is important because we have this in cars, drones, military equipment, and many other things as well. So again, limitations here in this. And the consequences of this, which is really interesting, is that at the end, as this is becoming more and more exaggerated, we saw the dollar being dumped because people don't. Number one, with the higher tariffs, there's less business, okay? So that's one reason for the dumping of the dollar. But we also started to dump bonds. So people started to dump bonds. And this is really important because that could destabilize the whole of the US economy if that continues. You know why? Because right now, the US is borrowing and owes more money than it currently makes in a year, which means that if things go really bad, they will struggle to pay their payments, and then the whole country can default. And why will people move away? Okay, firstly, as I said before, less trade. But look at what happens with the Russians. The Russians and their oligarchs had assets and Swiss banks, European banks, and that's where they had their money. And when the war against Ukraine started, those assets were frozen. And any income made on those assets is now actually being funneled back to Ukraine. And there's always talks about the fact that maybe, we should take this money for the Russians to pay for the war. And if there would be a true war or more escalation between China and the US, then it's very likely that the Chinese will keep on disinvesting from US treasuries because they don't want to be in a situation where the US would not honor its payments or when they effectively just freeze the assets and then there's nothing they can do about that. And that's an issue. Now, the biggest holders of bonds are Europe, Japan, and China. So, besides that, if we just summarize what's happening right now, we're still in a situation where we're worse off from an economic perspective. Now, Trump is supposed to meet Japan and to discuss tariffs today. If Japan would agree on a very generous deal where they, for example, pay for military backing for the U.S., if they pay for by lowering tariffs, by allowing American companies to do more business in Japan, and effectively sort of opening up, that could put pressure on countries like the UK to also offer a deal because the UK right now is without any major partners, no part of the EU anymore, and we need to sort of navigate between all these big nations and try to get a deal. So, but the long story short of this is that if Japan gets a deal, a very good deal, or not, if the US gets a good appeal deal with Japan, then it's going to pressure the UK, and that could put pressure on the EU and maybe Australia. Now, what's interesting here is if we indeed get true free markets, then that's good for business. If you're an American company, you want to sell into Japan or you want to produce stuff in Japan, vice versa, whatnot, it's good. Okay. The problem becomes when the government says, well, oh, Japan, you need to pay for this, you need to buy that, you need to buy this, or whatever. Anytime the government starts to mess with your money is usually when things go bad. Okay, um, so I'm not too much of a fan. But the key point here, though, is if we at the end of the day get a good deal, then that will be good for business. That will be good for stocks. That will be good for crypto. That could put pressure on others. But if the deal is bad, then it's going to be a difficult situation. Okay. For example, like Honda has already agreed to shift, some production of some of its cars from Japan to the U.S. Now, in the bits of China, though, the fact that tariffs are super high and the Chinese themselves have tariff on U.S. That is not good. That will slow down China. That will affect countries like Australia and New Zealand. It will affect the world pretty much. And right now, Trump says it's up to China to return for trade talks, where the Chinese says we are open for talks, but you need to be consistent in the way you communicate with us. You also need to be shown respect because right now you have different members within the Trump cabinet that says different things. But the key point here is that everybody says, "Well, come to me, come to my home, and we'll talk." But if both are saying so, it means that they're actually not talking with each other, and that's a big problem. Because again, economic slowdown. So how could this impact the markets? How could this impact trading? Let's take a look at the charts, and I'll lay down the levels that I'm watching. So we'll begin with the Nasdaq 100, which is the easiest thing. Okay. So already last week, if I remember correctly, we had this very strong push, and I said we're below the 200 moving average, and I said realistically we want to be bearish below these levels for this to go to the downside. The market did get rejected here, reached sort of half of this range. It would have been a good little trade, and then we pushed back up again, and again we're being rejected here because at the end of the day, Liberation Day hasn't improved the economy in the short term or in the long term, at least not for now. And I think people are going to sell here, targeting the lows and then even lower. Because in 2 weeks from now, we will have the PMIs. These PMIs are leading economic indicators. We'll get them from the EU, we get them from the UK, we get them from the US, and we're probably going to get them from a few other countries as well. That's going to tell us what's happening. Like realistically, ahead of the tariffs, the numbers should have been strong. Maybe this month they will show a bit of weakness, and then next month, definitely weakness, as a lot of the orders that would have been sort of distributed over the next 2 3 months would have all been, they would have gone ahead and produced all of that in the very beginning to avoid the tariffs. I personally think that's going to be in a very similar situation what we've seen before, with the prices being capped by that 200 moving average, and then at one point we have that push. Last time this happened, it took 371 days. If the same thing would happen here, then we're not going to be above that 200 moving average until March 2026. So what we need here is probably been selling here and then a bit of stabilization and then maybe a 1 point push higher, but for now I want to continue to be bearish. Now this is Bitcoin. Bitcoin, I'm going to talk with it because it's very similar. So Bitcoin has held up relatively well. So since we had this massive sell-offs in the um, Nasdaq 100, Bitcoin didn't really drop much more. I would have argued that when the Nasdaq 100 was dropping really sharply, especially here, this sharp drop here, it was 20% or so. I would have argued that Bitcoin would need it to be maybe at $60,000 a coin, but that didn't happen. Now this is good because it sort of shows resilience. Now, what's quite interesting is that we know that the U.S. government set up a committee to oversee the regulation of the crypto markets. They have now been working on this. I think it's about I think it's 3 months, and they have another 3 months left. So over the next 3 months, we want to pay attention to rumors, we want to pay attention to news that would indicate that we're looking to bottom out. And this, at that point, it would bottom out most likely when we push above 88.8. Okay, that's what I'm looking at. What's also interesting, if you would load something like the um, something like the M2 money supply. This is something that quite a few people are talking about right now. Then this indicator, which actually is the leading indicator for stock markets as well, that one is being talked about that is going to lift markets. So this one is exactly now. Let me see if I can just change color here. So you can see here that the market, this index peaked here in uh, September, and then later it peaked Bitcoin, and then we moved to the downside. But you can see that this liquidity index has been pushing to the upside for a while, and this one right now it is exactly on top of each other. But if you can push it a bit forward, it has a decent correlation, and does a relatively good job in explaining the movements of Bitcoin. And it does tell us that we can push to the upside. So you have two of those reasons. Okay. For now, though, we are below these highs. We are below the March 25th high, and I do think we can maybe drift a little bit lower, 80, maybe 76, especially if the data, which is anticipated in the next 2 weeks, come out poorly. In the case of Euro USD, we're stuck in a large ascending triangle. You got yourself 1, 2, 3 highs, then you have that trend line going via this low here, and the break here has to open up for a push towards 122. Okay, and it's astonishing. Just look at this. This is the Aussie dollar versus the USD. Even though China, their biggest partner, looks to be under severe pressure, maybe recession, that people are still more keen to buy Aussie dollars than holding US dollars. That shows you how people are moving away from the dollar. And here we're seeing even more than that. So we got that break to that pattern. We have uh, grazed this little buy zone. I had missed this with a pip or two. I think if from a short-term perspective, I would just be like this. I would just be bullish from these levels here, like this, and narrow it down here. So if we do go down to 113, 14, I think people are going to buy and target 115 more or less than 116, and then maybe higher up towards that target. Now, in worst case, we might dip below 12 and go a little bit lower, but the longer term bullish picture is not going to change. In the case of gold, so this is gold. So gold bottomed out here, and now we're in a very strong uptrend. And if we would load something like, let's see if we can get it to work. We can load something like a 20-day moving average. So the 20-day moving average has done an okay job. As long as we're not parabolic, it's done an okay job telling us when to buy this year, when we sort of go slightly below it. That means that if we would have this, because this is the end, a very strong push and then another push to the upside. It's extremely parabolic right now. I think if we would have a little slide towards 3,148, I don't think that's going to change the longer term outlook. I think people are still going to be buying between sort of these levels here. And if you wanted to narrow it down like more short term, then you're looking at this lows here. So that will be 1,184 and waiting for a dip towards sort of something like 3,260, something like that. So you look for that dip and then push to the upside. And this is quite interesting. Look at this US CPI. So we're dividing now gold prices, sorry, by inflation. So if you look at this, gold prices are still high. Let me change this to a 2-month chart. Actually, let's make it 3-month chart. So if you look at this, this is a high from the 1980s. And we still have another 9.5% before we reach that all-time high. And I think we can continue to buy here. And the reason for this is several. Firstly, when I say that they're selling dollars, selling bonds, some of that money is going here. When we say that people are afraid of inflation in the US, some money is going here. So you have those two very important factors, tariffs, and you have people moving away from dollar and dollar assets, and all that is pushing into gold. And then we have this high here. The problem here, though, which is really important to understand, it's not the time to go and necessarily, buy like gold and store it in your mattress, because that should have been done like, well, 24 years ago. This is definitely a trader's market. Last time we hit that high, last time it went parabolic like this, ultimately the market crashed over a period of 2 years. It crashed with 72%, which, if the same thing would happen again, a break of 72 would sort of take you back down here to levels from 2006. And while that seems very, very, unrealistic right now, these are the financial markets, and I have seen crazy stuff like that before. So yeah, I'm very bullish on gold. I'm definitely going to be buying that at dips. Finally, oil prices. Okay, so this is all oil prices. So last week we said, look, to sell here, let's go down. It did move down, so that would have been a quick trade. It looks exactly like the Nasdaq 100, right? Now we're pushing back up again here, and I still think people are selling. So people probably still gonna sell here more than they're gonna look to buy. Now this is the challenging bit, specifically for this one here. It's a bit of a challenging because this is starting to look a bit like definitely sort of a horizontal pattern here, and you can draw a trend line here. So there's probably quite a lot of stops here. Okay, so you need to be very careful because we could have a bit of a short squeeze and push towards double bottom pattern, double bottom here at 68.26. But I think realistically, if this doesn't hold, we can actually narrow it down. Let's narrow it down. We don't need to complicate it too much. We can narrow it down like that, and then pretty much be bearish from these levels. So bearish here, and then we say if we break above 65.97, we could have a bit of a short squeeze, taking up to 68. But then it really depends on what's going to happen going forward. But realistically, unless we have those free trade agreements and lower tariffs across the world, then oil trading at these levels is probably a good level. Okay, and I think that's it. I think we covered all the major markets. We covered gold, covered oil, Euro USD. Let's now see if you have any questions. And now we're gonna wrap things up. You always ask me what I've been trading. So I actually been trading quite a bit recently. So on crypto sliding, I made a bit of money on that. And then on cryptos, there's been a bit of volatility in cryptos recently as well. So I've been able to extract a bit of value on that as well. I went from not trading too much to effectively trading a couple of times per day now. Um, Back then, what I told you is that everybody needs to know when their system works good and when their system works less good, and that's where I am right now with my system. If I trade oil, sometimes I trade oil, but not always, because everything is so highly correlated now. So, well, the reason why I don't trade so much oil, is because I have made so much money on crypto that effectively almost all my money is on a crypto account. Okay, and I can't be bothered to move that money back into the other assets. I'll probably do it at one point, but right now, like, I have like 100 times more money on my crypto accounts than I have. So the way I'm trading crypto, for me, Bitcoin and Nasdaq 100 is the same thing. Okay, and oil to some extent is also the same thing, to some extent, because everything is so tightly correlated. The theme, the theme we're dealing with here is the same. Is a theme of risk off. It's a theme of tariffs. It's a theme of problems. Okay, so we have different assets to take advantage of this, and in the best of worlds, we have the theme, and then we try to understand which market is going to help me make most of this theme. Okay, so I would argue right now, not necessarily short Nasdaq 100 here. If I have a bit of a bounce, maybe short that would have been a better. I would have been better off probably trading the Nasdaq 100 than trading crypto, because I had to wait. So, for example, when the market was dropping here, I was short XRP and XLM, So XLM USDT, which was not like a clear cut, but I shorted around here, and then I had that little sell off, and then we're down here, booked profits. Then it moved up again. I tried to short, but then I got stopped out, and then not much has happened. XLR, Ripple, XRP. I did something similar. So XRP, I liked this a lot at one point, but it didn't really do what I wanted. So this is a big, as you can see, a big head and shoulders or a big descending triangle. So then one could have shorted here, and I think I shorted a little bit, but I didn't make. Most of the money was in XLM and a bit in XRP. But then here, short for this to go down. And I was hoping for more for this one, but it didn't. Thanks you so much, Virat. Nice. Very happy to see here. I'm looking at the comments. Thank you so much. Yeah, so I'll continue to do these videos. Next week, though, we have holidays as well. The markets are probably going to be quite quiet. So Friday, most markets are closed. Monday, US markets are closed, but European markets are offline. So realistically, you'll see less volatility unless something happens on the political front. Trump says something like that. So it's gonna be a bit quiet. And with the holidays, I'm gonna take next week off. So there won't be update after next week, but I'll be back after that. Thank you. You're welcome. So there's different ways of trading the markets, right? Um, use the replay function here. Test your stuff, see how it works. Just to see. Some people I like classical chart patterns. I like to trade those on the bigger time frames, 4 hours and above. Don't always work, but what's interesting is that when they do work, they work really well. There are months sometimes where they don't work, and you lose a little bit, little bit, little bit. And sometimes actually, even going against the patterns is better. So you have like a breakout, and then it's a false breakout. And then sometimes, you have a proper breakout and it just goes forever. And then you have people that just follow the trend. You push to the upside, you apply some fibs, moving averages, some RSI, divergence. And the trick is just to, find strategies. Quite a lot of people there that are teaching strategies. Try something that works for you, and then and that works as well where you're based in the world, and then just test it. Okay. For example, if you like me, you're not very patient. Like you want either the position to quickly show you that you're making money or you're losing, then breakouts during European session is good because you'll have a breakout and either you're making money really quickly or you notice you don't make too much money and you are almost about to be stopped out, uh, and you can take a decision based on that. If if you don't have time to be in front of the screens, for example, swing trading is better if you have a full-time job or full-time studies. Um, and if you don't mind buying dips and waiting a couple of days, waiting a couple of weeks, even better. The more time you have to give to your trade idea, usually the better. Okay. In the short term, um, if you're too eager, it's difficult to make it work sometimes. And if you really, really, really struggle, then just try to work with a different time frame. A lot of people are stuck in the 30-minute, 5-minute. The problem is that you have many more false signals in those short-term charts. Okay, if you start to work with a 4-hour chart and breaks in 4 hour, then it's more likely that it's gonna work out fine for you because you have fewer breakouts. Whereas in the 5-minute, you'll be, very bullish, very bearish, breakout, false breakout. The benefit of trading short term, of course, is that if you can make it in the short term, you have more opportunities. Okay, so this is your 5 minute. If, for example, this is just hypothetical because I don't think nobody would be able to do it exactly. But for example, if you look here, you're working with a downtrend, and then you would sell into these, would do good. Then when you get stopped out, and then suddenly you start to trade a range. So we're in a range now to some extent, at least since since midnight London time. And there's a lot of things you can do in here, and there's a lot of more ups and downs that you can trade with. But it doesn't mean that if you can make it, you make more money, but it's much more difficult. If I follow ICT, I have studied a bit of ICT. I have learned a little bit from ICT, but I haven't really spent too much time on it because I started to trade the markets before they blew up, and I already had a strategy that was working for me back then. So I was a bit lazy. I didn't bother to read up about it, but I have noticed some people are using some parts of it, and what I do like, which I never really applied before, is sort of the liquidity pickup, and I think they call it liquidity pickup. But here, for example, like it's effectively a false break. That's what it is. Okay. So for example, in Bitcoin here you have this drop, and then you have that big push back into the pattern. So I already had a word for this. I already had a word for this because this is what we call a fake move, fake breakout, when you break out and then the price pushes back into the pattern. Now, what sometimes happens is that the price will go to the other side of the pattern. Okay, so for example, here in Bitcoin, you have a few times here. Actually, you can even adjust it further. Like if you were looking at this here, you see you had this false move, and then it sort of pushed back in again. I never really bothered to trade those moves, uh, and I still don't really trade those moves, but I keep an eye on it. Okay, because I noticed that a lot of people are using these. So as soon as we have a push and it seems to be false, a lot of people will go back and try to trade against this. And that is something I think he popularized, which I've seen a couple of people that are good at trading that are using. So let me see here. There's another question. I will go with the trend. That's what I like, the trend. Mathematically, going with the trend is also much just you just make much more money. Like this is a bull trend in Bitcoin or everything. But just to give you an idea, the whole move here is 100%, and then you have this, which is 100%. I know it's not exact science. I'm just trying to make it a bit simple. And here you have a drop of 28%. Okay, and then for example here you have another drop which is um, sort of 20%. Now I know it's not exact, okay, but say you short here, you make 20%, and I wouldn't sell here to make money on this. I would try to go with dip, and then when I buy the dip, imagine I would have bought the dip, and this market goes up, and then I would have made 88, and then somebody here tries to sell, they make 28% more or less. But I'm like, no, I'm not gonna sell against here. So when the market has corrected, I buy and I make 103. So mathematically, if you just add up, if you could add up all the slides versus all the up moves in an uptrend, you'll see that the up moves are much bigger than the down moves. And it's the same, you can apply the same ideas into a currency, for example. Like if you look here, I know it's a very peculiar time, but if you look at this point here, you have 582 pip to the upside, and then here you have a 236 pip down move, and then here you have this move here, and then it was the same here. For example, here this was crystal clear when it looked like Trump was gonna win. And then when he did actually win on the election day, it was super clear that you just needed to buy a lot of dollars. And if you would have just gone with the trend, then you would have collected more pips on the downside and you would have a less of a stressful life than trying to go against the trend. I fall for false breakout. Yeah, I fall for the false breakouts a lot, a lot of time, a lot of time. And so, how can we deal with false breakouts? So, a false breakout, for example, if you look at the trader pattern, so let's make it simple. We can actually use, let's use this one. Okay. So, I published on Think Markets, I published a video on TradingView under the Think Markets account. Okay, so I said back then, a couple of days ago, I said we're stuck in a rectangle here, and I wanted this to be rejected, but it didn't. Just push straight up. But I said you have 1, 2, sort of 3 highs, 4 highs almost. So this is like a rectangle or an ascending triangle. So the trick here, what you can do, and I use it often, is that when you have a breakout, then normally you want this to push up very quickly. Okay, so in this case it's sort of here, so you want to see a candle push here a little bit higher. So what we can use what we call a time stop. So the breakout happens, you can give it 3, 4, 5 hours at most, and then you need a breakout. If it hasn't happened before that, many times it's a false move. So that allows you to close the position for a small loss. Okay, and then you can watch the market, because sometimes what happens is that you have a pattern just in the border, and then you can work with that. So time stops are really good, because that will get you in for a small loss half of the time at least, and then some other times the market's gonna almost come down and stop you out, and then it goes back up again, and then you just say thank you so much, you close that out for a smaller loss. And then sometimes what's going to happen is that the whole thing just comes down and you just get stopped out for the whole thing. But by using a time stop, you're not really losing the whole thing. And what will happen is that that will happen for sometimes long times, you know. And when you notice that something is not working, take a step back. Either trade with a smaller account, or sorry, with smaller lot sizes. So especially if you're sort of used to trade all the time, you know, like I'm used to trading, so I have like an account with a broker where I literally just have 2,000, and I just play around with that. Okay, so sometimes what happens is that instead of trading with my main account, I just go in there and I put some bets. I call it bets because it's not proper, but at least I'm still watching the market. But if I lose, I just lose a little bit of money, and then I get it out of my system, you know, the need to trade. You're welcome. So many people here. Okay, good. We're gonna wrap things up, and I want to see you guys hopefully in 2 weeks' time. So Wednesday, same time on Wednesday next week. Not next week, in 2 weeks' time. I'll be back online again, and we'll look at the markets again. Be careful out there. Do your homework. Use the replay function. Do a lot of back testing. If you put the hours in, it's gonna work out. But the cool thing with a company like Think Capital as well is that you can trade with bigger account sizes as well. So if you just learn to master it, later you're trading with sort of Think Capital and you're trading bigger account sizes. So even if you do 10%, if you do 10% on a 100K account, that's $10,000. If you do 20%, that's $20,000. In many parts of the world, with $20,000, I mean, that's what people make in a whole year, right? So if you just put the hours in and practice, and when I say put the hours in, use the replay function, back test your system as much as possible so you understand it, and then later, you have Think Capital, and then you have normal trading where there's no limitations on the drawdowns or nothing like that. The only limitations you have on those regular trading accounts is that when you lose your money, you lose your money, and you need to put more money into it. And yeah, I had margin calls, but I learned really, really quickly, really early on, to not lose more than 1 to 2% of my account per trade. You can stick with that. It's key because you will have times when it's super easy to make money, and then you will have times where it's not too easy to make money. Like, for example, I remember this very well in 2014. Like here when Euro USD was just dropping to the downside, I was just making a lot of money because it was so easy. Everybody was talking about the fact that the EU would break up and the EU would be over, so we didn't want to hold any euros, so everybody was just selling, and it was super easy. And then you had a couple of years here where trading the Euro USD was a waste of time because there was no proper trend to it. And if I would trade like a crazy person, which I don't, I would have maybe lost a lot of money when I was trading here. So yeah, risk management is key as well. Okay, thank you so much for watching. You have been great. I like all the questions as well. I like the comments. I like how you guys interact with each other, help each other as well. And I'll see you next week. Sorry to